Hey everyone, we are here for our next panel. We have Kevin and Mike. They'll be doing a talk around quants. I'll let you guys take it from here. Do you mind introducing yourself while the audience, you guys can confirm if you can hear them?
Of course. Hey everyone, I'm Mike. I'm the co-founder and CEO of Hummingbot. We're an open source project that helps anyone in the world use it to basically democratize and become a high frequency trader.
Guys, I'm hearing a bit of an echo right now. Do you guys do
that? Yes.
I'm not exactly sure.
So I hear it on your end. There's two reasons that might happen. It's because you have Crowdcast open on another window, or another way is for you just to refresh your browser.
That's probably what it was. Okay, great. So hi guys, my name is Kevin. I'm a managing partner at Galax Capital, and we are a trading firm which focuses primarily on liquidity provision. And our approach to it is definitely very quantitative.
Okay. Well, thanks everyone. So yeah, I think that it's been a long day. I think this is day 3 of the conference. So I'm sure everyone's pretty tired now. And but I think this session it's really just more of a conversation between me and Kevin. So as background, I've known Kevin for 3 years now. We actually also used to run a quant fund when we first started, but we only ran it for a little while, so we're not really the expert. We quickly pivoted to Hummingbot because we realized we were more engineers at heart rather than traders, and I think that building software and making that available to traders, I think at least for me was just a lot more less stressful than having to worry about managing people's money every day. And so I think that I give a lot of credit to Kevin because he's been running Galax Capital for the last 3 years now, 4 years maybe.
It's almost 3 years now. Yeah.
3 years, yeah, and I think that it's obviously he's better than I am at managing money for other people, but I think he's also much more experienced in terms of how a professional trading firm views the crypto market. So I'm really glad to have him here today, and hopefully we can have a very lighthearted conversation about what it's like to run a quant fund, how it's different from maybe like what people today are doing in terms of trading, and also how a quant fund views all the developments that happened this summer in DeFi and what it means for the future of trading.
Mm-hmm. Yeah, so, I think, I appreciate the kind words there, but I actually think, Mike, that you actually have a harder job than me because when you're building product, you have customers. We don't have customers, and just dealing with customers is definitely not easy. So, I definitely prefer what we do. It is more. I think it is probably more stressful, but at the same time, I think there's less headaches overall because there's just fewer constituents to deal with. So, I think it's just a trade-off, to each whatever they prefer.
Yeah, that's a fair point.
Mm-hmm.
So can you tell? So first off, can you tell us about what is Galax Capital's origin story, and how did you end up where you are today?
Sure. So we got started in January of 2018, and I had met my co-founder. We both went to school basically to be quants. We were in the Masters of Financial Engineering program at Berkeley, which is where I met him. We'd both done some stuff since then. He was working at a machine learning startup. He was head of data science over there. For me, I was working at 2 different Bitcoin exchanges. After I graduated from the master's program, one was a very early one called Buttercoin, lasted for about 2 years, and it went under during the bear market of 2013. And then afterwards, ran the trading desk at Kraken for another 2 years. So after 4 years at these exchanges, I thought it was about time to go more into the buy side, take a little bit more action in the market, and that's why we set up Galax Capital. And it's been a long journey for us, for almost 3 years, I think, which is crypto time. Quite, you see a lot of things happen, and definitely the landscape has changed a lot. But I don't think there's anything else I'd rather do. So I'm very happy to be doing what we're doing.
Yeah. Well, so I'm sure a lot of people in the audience are crypto traders, and I think I'm sure some of them have had aspirations of starting their own hedge fund in the future. So I think that obviously most hedge fund managers start by just trading for themselves. I'm sure you did that, and I did that too. What are some of the differences between managing capital for other people versus trading for yourself?
Mm-hmm. Yeah, I think there's quite a few differences there. And I think, I definitely agree with you. I think a great way to get started is just to trade your own account, your PA. And once you've built up a very nice track record, maybe at that point, other people might be willing to give you some capital. I think, there's really different parts to it. There's sort of the trading side, which is, I think, very similar to how you would trade for yourself. But then there's sort of the business side, which I think is quite a bit different. And that involves hiring people, creating the legal entities, figuring out the right structure, considerations about tax law, dealing with administrators who deal with the accounting, all sorts of things like that, as well as structuring the fees and what you're going to charge investors. And then on top of that, finding the capital, convincing people to give you capital, and then dealing with the mechanics of that capital flow. I mean, are you taking subscriptions, redemptions every month, every quarter, every year? How does that work? Stuff like that. So I think there's a lot that goes into it outside the trading component. Though I think, I think to get started, I think that component at least has to have, at least I think that, a good enough of a track record that it's worthwhile to try and expand and build out a firm around it. I would say that, another particular difference when it comes to the trading side, which is maybe a minor difference, which is how do you think about risk? If it's your own money, at the end of the day, if you lose it, you only have yourself to blame. Maybe you feel pretty bad, but you don't really have any particular obligations or fiduciary responsibilities to other people. While, if you're managing other people's money, there could be certain constraints on the kinds of risks that you can take, the kinds of instruments that you can trade. So, with that in mind, I think generally you're going to be a little bit more conservative, right? And I think, and I think it really depends on the manager. Certainly, there's always this, very pernicious, very bad kind of incentive. And, I think colloquially it's called OPM, or other people's money, where, if you think about how the fees are structured and whatnot, some fund managers might think about that as a free option on someone else's money, and maybe wants to take exorbitant risk because they keep some of the upside, but the investor takes all the downside. Obviously that's very bad for long-term business. It's unethical. It's not a good way to go. But I think certainly some people do think about it that way. So I think, in convincing investors to give you capital, there's not only sort of a show and a proof of competency that you're going to manage that you can manage their capital well, but that you will, that there's enough transparency, and you have a good enough character as a person that they trust that you're not going to do anything along these very pernicious incentive lines. So I think I think that's sort of what I also look for when I invest into other managers, because I also invest. I'm both managing capital, but also investing into external managers. I always look for two things. First, are they competent? And second, are they trustworthy? And I think both are extremely important. If any one of those is not there, you can have a trustworthy guy that's completely incompetent, is randomly going to lose your money away, innocently enough, but that could happen. Or you could have some guy who's very competent, but also very distrustworthy, and then they're going to find ways of making money off of you rather than making money for you, right? Mm-hmm. So I think both of those are very key attributes, and I think goes. I think that plays into how to raise capital, and it's about pitching investors that both of those two things are the case.
I really like what you said about managing capital of other people and like kind of how the pressure that puts on you, because I still remember this like viscerally, this one day when we were still managing a hedge fund. It was December 22nd, 2017. The market dropped 22% that day, and after 10%, our fund was actually not in the market. The bot just bought after the market went down 10, and then the market then dropped a subsequent another 10, 12%. And so I remember thinking, I'm like, wow, it's like I knew that the bot would just keep on holding, regardless of how far the market dropped. I think we actually ended up pulling the plug and selling, and basically just selling manually in order to protect our investors' capital. But I think that if it was our own capital, we probably would have made a different decision on that day, and we probably would have ended up making more money because the market actually did recover the next day. Mm-hmm. But I think that it's kind of like, I feel like when you manage other people's money, it's like you almost have to like be more kind of like use the risk parameters you're managing to for them, as opposed to perhaps like taking more risk or less risk for yourself.
Yeah, I definitely agree. I think overall, I definitely take less risk when I'm managing other people's money, and it's like it's a lot due to what you're saying is that their preferences are just different than mine. Generally, us folks who are in crypto, who trade crypto, we're used to this kind of volatility. For them, this is the most volatile asset class ever that they've ever been exposed to, at least for some of them who are not native to crypto. And I would say another thing too, which is, when you lose your own money, you just feel like an idiot. When you lose other people's money, you both feel like an idiot, and now you have to have a lot of very uncomfortable calls and conversations. So it's just like doubly bad. You still feel like an idiot, but now you're going to have a lot of awkward conversations. So it's just real tough sometimes.
Yeah, I agree. Okay, so actually, by the way, I want to say, just if anyone has questions, please drop it into the chat. Ken and I have known this for a long time, so we can just keep talking like this for like hours. So if you guys have questions, please put in the chat, and we'll try to address them as soon as you have them. So switching gears a bit, let's talk about some of the more relevant developments that happened this summer. Obviously, I think one of the biggest things has been the rise of these automatic market makers like Curve, Uniswap, and Balancer, and how they have accumulated a lot of capital and kind of and they're almost like a competitor potentially to some of the larger exchanges like Binance and so forth that have appeared. And so I guess my first question is, are you guys actually actively participating in those AMMs, either as a liquidity provider or as like a potential arbitrage?
Yeah, I think we've played around a little bit with both, but it's not our core focus. I think it definitely has gotten bigger and quicker to that size much quicker than I expected. I think if it continues to go that way, then we'll have to look into it a little bit more seriously. But yeah, we've dabbled here and there, and it's interesting the innovations that people come out with in the space. I always think that, and especially I think irrelevant right now. There's this huge debate that's going on in crypto Twitter. On one side, there's people who are saying AMMs don't really work in the long run, and there's other folks that say, oh, this is the best thing since sliced bread. Maybe the truth is somewhere in the middle. It's really hard to say. I have my own opinions. And I always find it funny because whenever something like this happens, it's always like there's always one side that sees it as, okay, we've completely reinvented, this wheel, and it's just a way better wheel than has ever been done before. And then other people are looking at it and saying, well, this isn't a wheel at all. This is just a square wheel. It's strictly what we had before. Why are you reinventing things in such a clunky and bad way? So, I think there's a lot to be debated, I think, on both sides. Each side makes some good points. I personally am on the side that I don't think that the AMM replaces the function of a club. And I think it's particularly difficult for market makers to be liquidity providers on the AMMs without, in the long run, getting picked off. And what I mean by that is, if you think about the structure of it, everybody pools liquidity to the exact same price levels, and the behavior is completely deterministic, right? So it's as if you were facing in the market somebody who you knew on the other side, you knew exactly what their behavior would be for every action that you took. I don't think that gives enough flexibility for the market maker in order to make profits in the long run. I think eventually you're basically you're going to be absorbing a lot of toxic flow as that flow gets smarter. Now, obviously, there's some things that compensate for it. Right now, there are fees associated with these AMMs. The flow itself is fairly soft. It's mostly retail guys. It's mostly Ethereum folks. It's mostly people who are not, what we would consider like, sharks, compared to, like, let's say, the prop shops in Chicago, stuff like that. But I do think that, and I do expect that over time, the flow is going to get more and more toxic. Liquidity is going to start evaporating because LPs start losing money. I think impermanent losses turn into permanent losses. And then, generally a little bit pessimistic about it. But, it could go either way. I mean, I understand the argument on the other side, too. So
yeah, well,
I don't want to just call it, we're happy to see people just try out new experiments. Pessimistic. Yeah.
So yeah, I mean, for us, actually, I feel like as a company that makes software for market makers, I would say a year ago, I was definitely in the square peg camp, where I was like, this is like, how could this work? How could this even work?
Yeah.
And I would say I've been proven wrong over the last year or so, because especially I would say the last few months, as and I think, to me, I think the reason is because I would say two things, two reasons. I think the first is, I think without in the abstract, if you just have if you're trying to earn fees, then you're probably going to lose money if you're a participant in a normal AMM. I think that it is easier to be a liquidity provider for these stablecoin AMMs, like Curve, for example, where there is kind of you're not really taking as much impermanent loss risk. I think that's easier. And I think the other way is, I think because of liquidity mining, quote unquote, where token projects are airdropping tokens onto people who are liquidity providers, I think it's added another source of revenue, and maybe in certain cases that kind of does compensate for the impermanent loss risk of certain changes.
Definitely. I think overall, I want to talk about both of those points that you brought up. I generally agree. I think the first is more about the correlation of the two assets that you're providing liquidity to.
Right.
Like for example, if you had WETH, right? You had WETH, and then you had another type of synthetic ETH, maybe from synthetics or something like that. Those two things are going to be highly correlated. I mean, pretty much you're just going to capture the spread. There's not going to be much impermanent loss. As opposed to Bitcoin, wrap Bitcoin versus ETH, they might not be as correlated. And then you can even think about things that are just literally anti-correlated, right? And then that would be where impermanent loss is the greatest. And so I think, when we look at the stablecoin AMMs, for example, the ones on Curve, for the most part, it's like that, though, with I think one caveat, which is that you subsume a lot of tail risk. Now, maybe very low probability tail risk, but you do subsume a lot of tail risk in that, all of these stable coins are correlated with each other until there's a peg break, right? And a peg break may not come for another 3 years or 5 years or whatnot. But when it happens, one thing can just completely get divorced in correlation from the other, and you're going to be subsuming all of that. Now, maybe what you make along the way, right, and all the sort of bid-ask bounce that you're capturing along the way over those 5 years more than compensates you for taking, on that day, a 50% loss, right? Because maybe you've already made 700%, 800% over those 5 years. So, that's definitely possible. But I think, it is important to know that, it's not purely a safe thing just to trade two things that right now look super correlated, in theory should be correlated. Maybe there is some tail risk to consider. That Tether intrinsically is a little bit different than DAI, or is intrinsically a little bit different than USDC. And then the other thing that I wanted to talk about is that, if we look at, I agree with you. If there was no fee, then all you take on is impermanent loss. You'll always be worse, right? Because you're always passive in the market. If the market moves up, you're always holding the asset that's worth less. If the market moves down, you're also always holding the asset that's worth less, right? But the fees compensate for it. And really, I think what it is that in the literature, the way they talk about this kind of phenomenon is very similar to the idea of why you would even post up a limit order in the first place, even on a CLOB or a central limit order book, right? The reason, if you think about what that limit order is, effectively, it is a sold option to the rest of the market to buy or sell from you at a certain price, right? Now, if the market was perfectly informed, they would only do that if you're on the wrong side, right? If the intrinsic value of that thing was higher or lower than where you're pricing it, they would take your quote, you would take losses, basically, right? Now, on the other hand, if the market was completely uninformed, then even with a 1 penny spread, your expectations go positive, right? Because the market is entirely noise. You quote a 1 penny spread, you're collecting half a penny every time someone trades in expectation. You don't have to be very smart market maker, right? So a lot of it just comes down to how informed is the market. If they're 100% informed, you can't even market make because you always just get picked off no matter what. If it's 100% uninformed, then even with a minuscule infinitesimal spread, you can always make money in the long run. So the market is somewhere in between fully informed or fully uninformed, and therefore it even makes sense to post up limit orders, in the book, in the central limit order book. Now, I think a lot of that same phenomenon is happening with the AMMs, in that there's a lot of uninformed flow, which is then subsidizing the liquidity provider for all the times they have to take losses when informed flow hits them, right? So as of right now, it does seem very profitable. It does seem like there is a greater proportion of uninformed flow in terms of the fees that it pays the liquidity provider on Uniswap, then the liquidity provider loses in permanent loss due to informed flow. But what my point is that I think over time that'll change. And as the size of these liquidity pools gets greater and greater, at some point it makes more sense for me to go hit that at the same time that I hit, if I wanted liquidity up or down, right, buy or sell, to hit that and the centralized exchange at the same time, build it into my spot router to hit everybody at the at the exact same time. Nobody can react, right? And then at that point, I get the best fill possible, and the whole thing is pretty toxic because I split my order across multiple venues, right? So I think when there's more sophistication that develops on the taking side for liquidity, then I think we'll see the character of the flow turn more toxic and more informed, and then we'll see liquidity providers pull back because they start taking more losses than what the fee gives them. So that's sort of what my narrative is, and what my story is for how I see it playing out. But obviously I could just be wrong. I mean, it could just be that the whole thing, there's always enough uninformed flow, always enough retail flow. At least today, people think of it as a fair system. So as long as that's the case, whether it is or not, doesn't matter. If they think it is, then there's always going to be a lot of people on both sides providing liquidity and trading against the liquidity providers, right? I think over time, as that narrative changes, if it does change, maybe then we'll start to see a kind of race to the bottom. Everybody starts pulling out on both sides. Sorry, I just started rambling, but that's sort of what I thought was.
Yeah. No, but I think you make a really good point about it's like there's actually the way the AMM is designed is actually quite similar to how order books and market makers are designed from a motivation standpoint. So as a market maker, you always want to chase the markets where they have a maximum of uninformed flow, right? Because that's the best market for you. Yeah. And I think liquidity providers and AMMs should also think the same way. And it's like, and I think it's what's I like that you brought the temporal aspect, because I do think that it's like there are certain times when certain markets and certain AMM markets are really great for liquidity providers. Maybe it's like the first time that some new asset has listed on an AMM, and they're also liquidity mining. So there's a lot of like uninformed people out there. Some people are trying to buy it, some people are trying to sell it. It's just like a lot of volatility in the market, a lot of traction, a lot of activity. And at that point, that's when you want to be an LP. But after the thing settles, the dust settles, and now it's like everyone who's bought the token has bought it, everyone sold it has sold it, and now you're basically facing the market. You're facing mostly arbitrageurs who are coming in to set the price. I think at that point, it may not make as much sense to be an LP as it was earlier on in that market's history. So I think there's a temporal element to it, and I think there's kind of like overall, I haven't tried this, but I feel like if I really run a quant fund, I would try to like almost like toggle between being an LP versus being an arbitrageur. And just like, basically however, like if I think the market's better for the LP, I'll be an LP. But I think the market's mature and it's more just, just floating on arbitrage, I'll flip to arbitrage.
Yeah, I think that makes a lot of sense. And I think even though as an LP, you can't actually control where you put up your prices, and you can't differentiate your prices from other LPs in the same pool as you, you do have something which is a unique action that you can take to be different than other LPs, which is that you can pull liquidity and provide liquidity at any time that you would like, right? So like overall, being an LP in like, let's say Uniswap pool, you're basically short vol and short gamma, right? Just to explain, vol means volatility, gamma is, it's a term in options, but it's basically you're short large moves happening up or down, right? Jumpy large moves up or down. So generally, when you want to be an LP, when it's best to be an LP, is when you think volatility is going to continue to be very low, right? But if you think all of a sudden tomorrow volatility is going to spike, then maybe that's when you start pulling all of your LP shares out of the pool, and then maybe you switch on the other side and you start doing the ARBs, right? Because then you know that the short vol people are going to start getting picked off as the price starts oscillating like wild, right? There's another consideration too, which is that as of right now, it's been happening a little bit, but I think not to its full extent, which is, there's all this debate about miner extractable value. And I think there's a lot of merit here, which is this idea that at the end of the day, the miner is the one who sequences all the transactions on chain, right? So if there's a huge arbitrage opportunity, why should they let you take it, right? Why not to replace your name with their name, and they substitute for you in that transaction and take the arb themselves, right? So I think, overall, there's two ways that miners can extract value. One is like this direct way, which is like replace name with their name, right? The other is through competition between arbitrageurs, right? Now, if you're an arbitrager and I'm an arbitrager, we see that there's $10 on the table for the taking. Now we both need to get into the next block. Maybe I'm willing to pay $5 as a gas fee to get that included in the next block. Maybe you're willing to pay $6. Maybe then I'm willing to pay $7. Pretty soon I'm willing to pay 99.99. 9.99, right? And then at that point, I only capture a penny. All that value, all that excess value of the ARB actually goes to the miner, right?
Mm-hmm.
So I think there's a lot to be said about, how viable is it in the end game when, everybody becomes sophisticated. The miners, the arbitrageurs, the market makers, the takers, everybody becomes sophisticated. Is it even possible to even do ARB on these AMMs that the miners, can't just take themselves?
Yeah, I actually would argue. I would argue it is, and the reason I think it is because I think the miners can really only capture. It's like, yes, I think if both legs are on the Ethereum blockchain, then absolutely miners are gonna like take all those ARBs. But realistically, most of the time, only one ARB is on Ethereum. The other ARB is on a centralized exchange. And so if miners only see that, if most people only see that one leg of the trade, it's hard for them to ARB because they don't know how you're hedging that trade.
Right. Yeah, I agree that in that case, they wouldn't be able to take it. But I think in the end game, the miners themselves, they all have trading desks at this point, right? Now, they're not the most sophisticated trading desks because they're not specialized in it. But I think over time, they can at least specialize in this one particular strategy, which I think, it's like see a low price here, see a high price there, buy the cheap one, sell the expensive one. I mean, eventually they'll be able, like within the next 5 years, probably they would be able to do that, right? So
yeah, that's true. That's true. And also, if they were running humming bots, they would already be doing this. So.
Oh, there you go. Well, they should just do that. Just cut it. They could just cut in line and just have it like that.
That's right. That's right.
And on top of it, they probably have some very good deals in terms of fees with the centralized exchanges because they probably push so much mining flow through there too, right? So they're probably on a very good fee tier for that too. So I think a lot of interesting questions. Hard to say, but those are my thoughts. Yeah.
Okay. All right. Well, it's been incredibly. We could go on with for hours, literally hours. But we only have 5 minutes left. I want to make sure we answer some questions from the audience. So let me go through a few questions that people have asked. So one of them is, say someone has, can you guys elaborate on risk parameters used when managing other people's money? Sure. Yeah. So I would say we only ran a small fund. At least for us, it was like it's very simple. It was like we were trying to basically ensure. I think we were trying to ensure something like less than like 20% annualized volatility. So that was like a target. But I would say it was hard to manage to. So I would say for us, it was a little more like finger in the air type of management in terms of, but I think for us, we knew that our investors were more risk averse than we were. That's why they were investing in us. So for us, we wanted to make sure that our users had no more than like a 10% drawdown every month. That was like our biggest fear, I guess.
Mm-hmm. Yeah, I think there's a lot of ad hoc stuff, and there's also some quantitative stuff. I would say that a lot of it is more of an art than a science. Like just as an example, for example, you have all these different metrics. Like you look at this back-tested strategy has like a Sharpe ratio and a Sortino ratio, and a trainer ratio, information ratio. You got all these ratios. Well, which one matters more, right? Like you could say, oh, the Sortino ratio matters more because downside risk is worse. You could say Sharpe, you could talk about leverage, scalability, stuff like that. But overall, the judgment still comes down to the manager on what they value and also inferring what the investor cares about, right? You can have all these numbers, but at the end of the day, how you even weigh them between each other matters a lot too. And then on top of that, there's more ad hoc risks, right? For example, if you're putting up at most 10% of your capital on any individual exchange, then that's different than putting up at most 30% of your capital on any one exchange, right? So let's say you have 10 exchanges. Now, arguably, you could say, okay, I'm not going to put more than 10% of my capital on any one exchange. Now, if any exchange gets hacked, then we can only lose at most like 10%, or maybe even less than that because there's some recoverability value, right? But now you have a lot of frictions, right? Because now, like all of a sudden, there's a huge arb between Huobi and Binance, and you're out of one asset on one, but you have more assets of that on another exchange. But then for asset number two, you have it all on the other exchange, but not on the first exchange, right? So now you have to there's a lot of operational rebalancing. You have to pay the gas costs. There's all sorts of hassle there. So, it creates frictions, which may lower the return. So now is that worth it? Maybe keeping 30% is fine. What is the actual chance of an exchange getting hacked per year? Like, is it like for major exchanges at 5% annualized? Well, then, maybe that's what you can take into consideration. Do you, some other considerations, like do you take that smart contract risk? Let's say there's a huge yield fund that's just released yesterday, and the yields are insane. They're like 4-digit, 5-digit yields, and then in 2 days that yield is going to be like double-digit yields, right? It's going to lose 2 digits or 3 digits in 2 days. right? But you don't have time. You don't have time to go read over all over the code, everything about it, understand its full mechanics. At what point do you say, I've done enough due diligence? This is fine to put 5% of our capital at risk at this thing that's earning absurd yield. If we lose it, we lose it. But but how much research do you do, right? Like, do you research it for 1 hour? Do you research it for 5 hours? Right? All this time, the yield is decaying, right? So kind of the right balance point. A lot of it is just judgment, right? And a lot of it is about what your LPs, what your investors will accept, right? And ultimately, it's their money. I mean, ultimately, you have to reflect what their preferences are, right?
Yeah.
So,
they
all have different preferences too. They all have different preferences too. Yeah.
Sorry, I want to make sure I get to the last question because we only have like 1 minute left. But I think the last question is a good one. What's the role of a money manager or hedge fund manager when DeFi automates trades? So the example is token sets, but I think we can also use Wi-Fi for this. So like it's in a world where there are on-chain hedge funds. What's the role for like normal hedge funds?
Well, I think the difference between most of these on-chain hedge funds and what most I think quant shops do is that the on-chain stuff is fairly simple. Mostly it's like if you think about Wi-Fi, for example, it's a robo-advisor. It's constructed pretty well. We were actually very long Wi-Fi for quite a long time and did well there. But I think overall, that's not really an actively managed strategy, right? We're not really looking at like historic data, back testing models, using neural networks. We're not using like very sophisticated things because at the end of the day, all that logic has to go on chain, right? Like that robo-advisor has to have logic coded in Solidity for how it's going to operate, right? So, for the most part, I think, it has to be kept very simple or else, it's going to be very hard to automate. How do you retrain a model? How do you recalibrate hyperparameters? There's all these sorts of ideas. I certainly don't think that you could have like RenTech, right? Renaissance Technologies models codified into Solidity and made into like an on-chain kind of platform because so much of the value is derived from the secrecy, right? The secret sauce is that so that nobody else can copy you. If you see one particular strategy working very well on Ethereum, well, you should just clone over that code, right? And you should make your own modifications. You should learn something from that. That alpha will disappear very, very quickly as more and more people pile into it. And also on top of that, a lot of these pools are not capped, right? So it's just like, okay, maybe this thing can make like 50% a year on 10 million. Well, once everybody starts piling into it, it goes to 100 million. Well, now you start to see what happens, right? And you start to see that already a little bit with the Wi-Fi, with all the vaults, right? There are the Y vaults. You see that with Y pool. You see it, all over the place. You see yields coming down because everybody's chasing it, right? Everybody's putting in their capital, saturating out the market. Now, if you could have something that's more protected, a private strategy, a secret strategy, well, then at that point, hopefully you can keep it going for as long as possible. Alpha will still decay, but hopefully it can last longer than in the public domain.
Yeah, well, it's coming with Aztec and privacy protocols, so it could be possible in the not too distant future.
That'd be interesting. If one of these protocols comes up with this kind of like obfuscated code or some kind of privacy, zero knowledge proof or whatnot, we might give it a go. We might code up our own, automated strategy and put it on. That might be pretty cool. Might be fun to do.
Yeah, definitely. All right, cool. So we are out of time. We need to transition to the next session. Thank you guys so much for this. This was really great.
Thank you.
Yeah, thanks for having me. Yeah.
Yeah, of course.